Well, we're back here again, and now we're talking about Corporate Law 101 and Entrepreneur's Guide. We're working on Section 2, Part 4, Options and Warrants. Let's go through here now. First let's start before we get into the slide. What is a stock option? A stock option is a security which gives the holder the right to purchase stock, usually common stock, at a set price. This is called a strike price for a fixed period of time. Now, stock options are the most common form of employee equity and are used as part of an employee compensation packages in a lot of startup companies, especially high-tech companies. Okay, so if you're the founder, you're most likely going to use the stock options to attract and try to retain your employees. If you're getting as an employee, you're going to join, or even as an outsider, you want to join the startup, you're most likely going to receive stock options as part of your compensation rather than some additional money. Now, a stock warrant is just like a stock option because it gives you the right to purchase a company's stock at a specific price and on or before a specific date. However, a stock warrant differs from an option in two really key ways. A stock warrant is issued by the company itself, and new shares are issued by the company for the transaction. Unlike a stock option, the stock warrant is issued directly by the company. The stock option is exercised, the shares usually are received or given by one investor to another. When you do a stock warrant and it's exercised, the shares that fulfill the obligation are not received from another investor, but directly from the company. Now, companies often use stock warrants to raise money. When stock options are bought and sold, the company that owns the stock does not receive any money from the transaction. However, a stock warrant is a way for the company to raise money by basically selling its equity. A stock warrant is really a smart way to own shares in a company because a warrant usually is offered at a price lower than that of a stock option, and it generally has a longer term, where a normal option is maybe 2 years to 3 years. A stock warrant often can last up to 15 years. So in many cases, a stock warrant can prove to be a better investment than a stock option for your long-term investments, if that's what you're looking for. A stock option is really what they call a call, when a buyer enters into a contract to purchase a stock at a specific price by a specific date. There's nothing magical about it. The idea is that the purchaser of a call option believes that the underlying stock will increase over time, and they want to buy the stock option or warrant, in this case, underlying the stock at a lower price, what they call a discount. And that, therefore, when they get it and the stock is sold at a later time, it's worth more, then they make the differential and everybody's happy. Now, I want to warn you that options, especially employee stock options, are really interesting. And I want to say this here because a stock option program is a very complex legal document. So make sure that you get good advice from people who understand stock option programs before you proceed with an employee stock option program, because there's qualified and unqualified programs. You really need somebody who knows what they're doing there. But for warrants and things of that sort, as long as there's good deliverables and a fixed date and an exercise price, as we've outlined here, you're pretty much in pretty good shape to issue those along the way for shares, as long as you understand how that's impacting your stock table so that you don't lose control of the company, things of that sort. The biggest difference between an employee stock option and a warrant for these kinds of things, these two types, is that in a warrant, you have a strike price, or an option, you have a strike price. In a stock option as an employee, you have what is called a grant price. That is the price that the company is giving it to you at. So you're supposed to get $10,000 in additional salary. I'd rather give you 2% of my company. So I hand you 2,000 shares or whatever the number of shares is, and that would be represented at the current market value at the time the employee receives the option. And so since it's the same price, there's no taxable impact. Everybody's happy. Okay. And the stock, of course, has a value, and how you go about determining that value is again a pretty complex process. But let's assume for the moment that you have common stock in your company and it's worth $1 a share. And let's say you give 10,000 shares to maybe a software developer that you want to bring in and have work with you. Then each of the software developers would be getting $10,000 of compensation, and they would have to pay tax on it. But if this is a stock in an early stage company, the stock is not liquid, it can't be sold right away, so the employees are getting something that they can't turn into cash right away, but they have to pay roughly $4,000 in taxes as a result of getting it. Most of them don't like that. That's not good, and that's why options are preferred compensation method, because again, if your common stock is worth $1 and you issue someone an option to purchase the stock with a strike price of $1, then at that very moment in time, the option really has no exercise value because it is what is called at the money. It's a term of art used by Wall Street. And the tax laws are written in the United States that provide that if an employee gets an at the money option as part of their compensation, they do not have to pay tax on it. Now, the laws have gotten, a lot stricter in the last few years, so make sure you go get a qualified attorney to talk to you about the stock options and how you do various options and warrants and things of that sort, as I've said. But they're an excellent way for you to attract and keep employees. Those who understand options theory, and even those who understand the probabilities, you have to realize that at-the-money options actually are of value, because if I could sell them, I'd get the money and I didn't pay anything for it. So it does have value. We're going to talk about one more thing, and that's called vesting. And I guess we're going to talk about two things: vesting and exercise, and how that happens. Exercise is when you have an option granted to you as an employee by the employer, or in this company, or warrant, and you go to get that warrant now to be functional within the company, and that is exercise it at the exercise price, as you can see there. So the exercise price is what you've already agreed to. The execution of the exercise is when you sign the piece of paper saying, I want to buy the stock at $1. The stock's now selling for $2. You just made $1 a share, 10,000 shares. Everybody's happy. Okay, you got your 10,000 bucks back. And as I say, they're an excellent tool for both attracting and retaining key employees, and I recommend them highly. Vesting usually happens over a 4-year term. But some companies use 3-year terms, especially in hot markets where there's either a lot of no unemployment and you need employees badly, or the skill set of the particular individual is such that you really, really need him or her to be on the staff and want to find a way to vest them out early. The way vesting works is that your options don't belong to you in their entirety until you have vested in them. So let's assume that we're still doing this 10,000 shares that we talked about. If it were to vest over 4 years, you would take ownership of an option at a rate of $2,500 shares per year. Now, some of them have more shares in the first year and less shares at the back end, but generally, you think of it as a 25 times each year for the basic 4 years, you'd end up with your 10,000 shares. The nice part about vesting is that you get the full grant, and it's at the fair market value when you join. And even if that value goes up a lot during your vesting period, you still get that initial strike price that we talked about. So as you're making the company better, you're vesting in a company that goes up. And for example, when I worked at Motorola, that was a publicly held company, we used to get shares and options at, let's just say, $28, and the stock was at that time at $28. Well, by the time my shares exercised 2 years later, it was at $44. I made a lot of money per share for every share that they gave me at the grant price. So I was a really happy camper. It kept me at Motorola for 11 years, so it wasn't too bad. Turning our attention now to basically warrant earnouts. Well, what is an earnout? An earnout basically says that you are going to cause someone to do something in order to earn out their shares of the company through the warrant or through the stock options. And let me give you an example on an option. you bring in a president of a company or someone to work as general manager or even vice president of sales, you want to give them a sales commission. So you give them a sales commission and tell them that if they meet their quota, they don't get any new shares. If they exceed their quota by 110%, let's just say, by 10%, they would get 50 shares. If they do it by 20%, for every 10% they get 10 shares or something to that effect. Those are bonuses, and they allow you to exercise those over a period of years and fix the exercise price and incentivize people to earn out shares. In a warrant, it's kind of the same thing, except there you need to be more specific on the deliverables, because they may be for, I want you to deliver software to me that is fully functional, tested, and ready for market. I'll give you some when you deliver the first set of code. I'll give you some once I've tested the code, and then I'll give you the remainder upon acceptance of the code by the company and first commercial use, something to that effect. So all of those need to be laid out, and so you want to show that you would receive so many shares based upon the completion of this, and then you want it to be ruled by the reasonable satisfaction of the board of directors of the company, so that if someone says, well, no, you didn't earn it, the board of directors is the ones that are saying you didn't earn it. It isn't an individual, and you need to have those earn-out capabilities clearly and unadulteratedly subjective, not objective. I'm sorry. You need those options to be objective, not subjective, so that you're able to measure that whether or not they were completed. I guess bottom line is options and warrants are excellent ways to incentivize and keep employees, and I think you'll see a lot more of this as the market becomes tighter for employees, and the specialists employees are now compensated more and more in the company. So thank you. Okay, let's look at now, this is a stock table for options and warrants. Okay, let's go to the warrants, because there's no options being issued here, as you can see, but the categories are pretty much the same. And that is who is receiving the actual warrant, what day was it issued, when is it redeemable by, in this case, 2 or 3 years. Okay, when was it exercised? Well, it has not yet been exercised. It's redeemable till here. When it is, we'll then issue a share certificate. The amount of the warrant is $3, so for each share, it's going to be $3. The consideration is dependent on how many of the shares are exercised, and the capital paid is, can be $3, but they haven't yet paid anything, so we just showed it as all 1 cent so that it stays there. And the quantity that's available under this warrant is 10,000 shares. Again, you can make changes to this document on an ongoing basis here by touching the little pencil. It will open up the document and allow you to make changes to those processes, and of course then you can add options and things of that sort up in the above you where the stock table is, so that you can add shares and warrants along the way. And that's it for now for this tutorial. These tutorials are copyright 2017 BrainTech CSI Inc., all rights reserved.